You've probably heard the phrase buy low, sell high, and probably recognize that it refers to the trading of stocks on the stock market, but what really are stocks? A stock is a share or portion of a company that is publicly traded on a stock exchange. In the US, there are two main stock exchanges: the New York Stock Exchange, also called NYSE, and the National Association of Securities Dealers Automated Quotations, but no one calls it that, just call it NASDAQ. When you buy a stock, you are buying it from the exchange and not from the respective company directly. The company has already sold the shares of itself that it seeks to make public to the exchange. Same goes for when you sell a stock, you're selling it back to the exchange. The owners of companies tend to be majority shareholders in their companies, that's why they're so rich. Jeff Bezos, for example, owns 909,414,000,000 shares of Amazon, which amounts to about 10% of the company. The total value of a company's outstanding shares is called its market capitalization. Outstanding shares mainly include the shares of a company that are publicly traded on an exchange, but are defined generally as all shares of a company held by investors, whether they're sold privately or publicly on an exchange. And yeah, experienced investors will sometimes buy shares of a company directly from the company, but that's beyond the scope of this video. When a company's stock is available on a stock exchange, it's called a public company. Most, but not all companies are public. Mars Incorporated, for example, which makes M&M's, Snickers bars, Wrigley's gum, among other tasty treats, is a private company that cannot be traded on the stock market. Roblox, however, actually did go public a few years back, so you can technically invest in Dress to Impress. Have you ever seen those crazy graphs that bounce up and down? If yes, then you were probably looking at what's called a stock quote. We'll discuss how to read those more in depth in another video. The high points on this graph are called the bulls, and the low points are called the bears. Likewise, when the majority of stocks are going up, that's called a bull market. And when the majority of stocks are going down, it's called a bear market. But why do stocks go up and down like this? Well, these ups and downs reflect changes in a stock's value, or price. Stocks, like anything in the economy, follow the laws of supply and demand. If a lot of investors decide to buy or hold a stock, the price goes up because less of that stock becomes available on the open market. The same is true vice versa. If a lot of investors are selling the stock, then the price goes down because more supply is available. This reflects the inverse relationship between supply and demand. More demand equals less supply and higher prices because people want the product so much that they are willing to buy it at a higher price. Therefore, it's in the company's best interest to raise the price of its product. On the other hand, less demand equals more supply, and in this event, companies will lower prices to encourage people to buy their products. Like and subscribe for a supply and demand video. But at any rate, things like company earnings and performance, government legislation like new taxes and the stuff that the Federal Reserve does, and other crazy stuff that goes on in the news, cause stock prices to fluctuate because they motivate investors to either buy or sell the stock, affecting a stock's scarcity, the supply and demand for it, and therefore the price of the stock. Scarcity is the fundamental force that undergirds the entire economy that we could talk all day about, so we won't talk about it now. But like and subscribe for a video on fundamental economic concepts. When we trade a company's stock, we don't identify it with the company's full name. You can probably see how that would get a little complex. If I wanted people to invest in my company, Supercalifragilisticexpialidocious Incorporated, I wouldn't want them to have to type that out every time. Companies therefore use ticker symbols, which are similar to their names but typically no more than 5 letters, so that people can type those in to identify which company they want to invest in. Apple's ticker symbol is AAPL, Nvidia's ticker symbol is NVDA, Ford's ticker symbol is F, and the chemical company Dow's ticker symbol is DOW, or Dow. How nice. Okay. We've talked about what a stock is, but why do people trade stocks? Well, there's a few reasons, and to an extent, it depends on the specific investor and their needs, but I'll give you 3 of the most glaring. Number 1 is for speculative plays, or when you speculate that the value of a stock will go up, particularly in the short term and with one particular stock or industry. This is what people mean when they say they buy low, sell high. This could look like investing in toilet paper companies because the toilet paper aliens just came to Earth and said they were going to eat all the toilet paper. Less toilet paper available means that the value of toilet paper goes up, and therefore, the value of a company that produces toilet paper goes up. The number 2 reason that people buy stocks is for dividends.
Tell them to bring me my money.
Dividends are payments, often quarterly, and quarterly means every quarter of a year, so that's 4 times a year or every 3 months. And these quarterly payments are made by companies to shareholders. And yes, it's exactly what it sounds like. Free money, just for holding a stock. We'll talk about dividends a bit more in depth in future videos. The number 3 reason that people buy stocks is that, even though there is always risk involved, I mean, companies can go bankrupt and the entire market can crash like what happened in the Great Depression, stocks do tend to increase in value over time no matter what. This means that even if, for example, Nvidia is down a few dollars today, it's increased in value by nearly $200 since it went public in 1999. In fact, if you bought 100 shares of Nvidia in 1999, when one share of it was worth 4 cents, you'd have spent only $4, but would have made over $17,000. Because as of July 16th, 2025, when I wrote the script for this video, one share of Nvidia is worth $170. Stocks are what's called an appreciating asset, and that means that they go up in value over time. So as long as you have enough money to pay for what you need and to account for emergencies, it's a pretty good idea to drop your leftover income, known as disposable income, into stocks. But this also depends on factors such as risk tolerance and time horizon, which we'll discuss in the next video. Thank you all for watching.